Hi, so happy to have Kristin on with us today. We thought we'd have a chance to visit with you guys about some of the changes to the dynamic asset allocation. Obviously, we're in an environment where things are changing rapidly. There are a lot of risks present, so we're still fairly conservative as it relates to positioning, but thought it's a great time to kind of talk about the rationale and what we're looking at as we're looking forward. Overall, we're reducing our net equity exposure by 2%. We're increasing our exposure to real estate by 2%. We're reducing our exposure to fixed income by 4%, and we're increasing our exposure to liquid alternatives by 4%. And there's a lot of nuances in there, but I thought I'd just start with kind of a broad overview. And Kristin would love to visit with you as we think about correlation and rationale for the changes.
Yeah, that's great. And thank you so much for having me, Leah. I'm excited to be speaking to you all today. So just for some context around, like what we saw in Q1, really being shaped by the geopolitical shocks, inflation pressure, and a factor rotation. Though, overall the earnings and the growth, that we're seeing broadly remains resilient and supportive of risk assets. What we're seeing specifically is that the markets continue to reflect a price shock, inflation. Not so much on the growth side. Our posture reflects patience and risk management, not a huge directional shift. So at a high level, the changes that we made this quarter were incremental and intentional. We are really trying to be intentional about where, like the sources of risk come from within the portfolio. Instead of trying to predict what happens next, we focused on one question: how can we make the portfolio resilient across a range of outcomes? And so, like you heard from Leah, there were three key changes. First, we reduced exposure to traditional beta slightly across the equity piece and fixed income exposure within the models. We increased real assets, particularly real estate, where we're seeing kind of attractive entry points after a period of underperformance. And then third, we did add to liquid alts, which, we're really seeking diversification and to help with drawdown exposure. So overall, we are reducing reliance on stocks and bonds and increasing exposures to the areas that behave differently. We're not reducing risk, we are reallocating it to these other sources of return and risk.
Yeah, and I think it is such an interesting environment because not only we certainly have a non-traditional administration in the US, which presents risks one way or the other, but you also have so much innovation that's happening. The world is changing very quickly. And so for all those reasons, I think what's fascinating is we don't see an environment where money is leaving the equity market in general when there's concerns about what's happening. You see these big rotations that are occurring, and I think those rotations are happening for multiple reasons. I do think real estate is a really interesting area. Real estate is an area that has underperformed for a number of years, and I think the dynamics from a supply and demand perspective are really changing, both on the commercial side as well as on the industrial side, and that's an area where we really could see nice outperformance. And I'd love, Kristin, for you to talk a little bit about how that, from a correlation perspective, how that fits in with the rest of the overall portfolio.
Yes, certainly. And, just to comment on where we're at today, the reason behind these changes really comes down to the type of environment that we're in, which we're operating in a completely different type of regime than even the past 10 years, right? We have higher inflation, higher interest rates, and that is what is changing how these assets behave, especially correlations. Traditional diversification, particularly across, stocks and bonds and like a 60-40 typical balanced portfolio, hasn't really been reliable. And so we're expanding that toolkit beyond just the equity and fixed income markets to build a truly balanced portfolio. We're really being intentional about how we do portfolio construction, not prediction. And just to comment on, the correlations, particularly between stocks and bonds, those correlations have become less stable. We can't 100% rely on the bond market providing that defense like we have in the past, pre-COVID. But at the same time, real assets and like the real estate are providing that source of diversification. So we're really not just looking to add to holdings, right? It's about adding assets that behave truly differently when you need them to. And just to put it into one sentence, not all diversification is created equal.
Yeah, and I think I think that's a great point, and it's also helpful to think about as we're looking at projected cash flows and the impact to the portfolio as well. If we do get into an environment where rates are coming down, which is a big if, right? We don't know what's going to happen to oil prices, if we're going to be more in an environment where inflation is much stickier than what we expected. But if, let's say, 6 to 9 months down the road, if we get into an environment where rates are coming down, then almost every high quality corporation or municipality has written in that they can call bonds. And so you could have a lot of call type of activity happening on the fixed income side. Whereas if you look at real estate as well, you could have much more sustainable cash flows and be able to really kind of look at basically duration a little bit differently.
Right, and just to comment on our allocation to fixed income, while we do still see that fixed income provides a source of stability, the higher yields and the tighter credit spreads that we see today create, not a super attractive risk to reward ratio. And so that is what is really driving the smaller role with that 4% reduction within our models. And so if we see a meaningful widening of spreads or the decline in rates, like how you mentioned, Leah, that would improve the case for rebuilding this allocation. But you touched on quality, within the equity space, we saw a factor rotation in Q1, and that broadening exposure, the broadening of the market leadership, really supports maintaining a diversified allocation across equities, and rebalancing does still capture opportunities within segments that are relatively oversold, like exposure to the growth factor, so those are the opportunities that we are capturing with this rebalance, while intentionally increasing exposure to quality within the equity market itself as well.
And I think you bring up a good point about quality. And obviously we saw some nice outperformance in dynamic in the first quarter because of the overweight to quality. But I think it's also important to talk about how quality has changed from a sector perspective. And you and I were visiting about this a little bit. Obviously, and a sector that performed very well during the first quarter was energy, based on what's going on in the Middle East. And I think if you would have looked at the energy sector pre-COVID, the sector had so much debt. It certainly wouldn't have been considered quality. But one of the big things that happened since COVID is so many companies restructured their balance sheet, they delevered, you've got really nice positive cash flow, and it is definitely considered more quality driven. And yeah, it's just interesting to see how the different sectors change over time.
Yeah, and within the quality sector, we're really focusing that specific factor, focuses on companies with a strong balance sheet, relatively low debt compared to their peers. And what we're seeing within the energy sector specifically, pre-COVID, capital intensive, highly levered, like you mentioned. But today, in this post-COVID world, where we see the energy sector have a higher free cash flow, being shareholder focused, and with the lower debt like ratios that we're seeing, what like used to be a value trade within the energy sector is increasingly a quality and income story, which for quality, really what its role within portfolios is to protect on the downside while still like participating on the upside. And so we see the energy sector really come through with those behaviors.
I think the other thing that's kind of surprised people, definitely, the rotation that we're talking about kind of started in November. And obviously there's concerns from a capital expenditure perspective as it relates to AI, which has kind of caused growth to underperform a bit. And you've seen this big outperformance in value. But the other area where you've really seen outperformance is in small caps. And it's worth mentioning we have a fairly large overweight in dynamic. It's about 17% versus 13% for the strategic asset allocation. And, small caps were an asset class that really underperformed for a long period of time. You obviously had higher interest rates in 2022. But even prior to that, you went through a period where the quality of small caps had gone down some because companies weren't going public anymore. They were staying private longer, and there was kind of question about the quality of small caps. And the big change that I think that we've seen is as we talk about AI and the impact of technology across the economy, you are seeing a lot of smaller companies, especially smaller industrial and smaller kind of more mundane industries starting to embrace AI and technology differently. And you're really seeing operating margins and earnings increase in that area, which is really allowing that sector to really start outperforming. And we've kind of seen that over the last 5 or 6 months, but would love to hear your thoughts there as well.
Yeah, the one thing that I would add is for small cap companies, what is also supportive of that sector is, the weakening dollar. With these smaller cap companies tend to do business, focused within the U.S. They're not as global as, their larger cap counterparts. And so with, the weakening dollar, that is, supportive of small caps with, who earn their revenue and their income from like domestically. But yeah, I think that's a great point.
I completely agree with you about the dollar as well.
Yeah.
The only other thing that I would mention is when people are thinking about asset allocation, it is important to think about asset location, and you tend to have higher turnover in small caps, and thinking about that within a Roth or an IRA is always important. But yeah, it's exciting to think about what the next quarter holds and to see how things are constantly changing. And I love the conversations we're having about asset allocation and able to, to pivot more frequently.
Yep. And it's important, it's not just about creating that diversified portfolio, which is, where we spend time thinking about asset allocation. It's about creating one that's optimized on the after-tax basis as well, which is where the asset location comes into play. But yeah, good point.
Definitely. Well, thank you so much, Kristin, for coming on. Appreciate it.
Thank you so much for having me, Leah. This was fun.